Hey guys, welcome back to another video. And today we're going to talk about Fitch, rating agency, and they downgraded the US government's credit rating from AAA to AA+. Now this just happened recently, and this has sent ripples through the market and our politicians. Many have tried to defend the current state of the United States monetary policy, as well as those trying to point out the larger problems facing our country and the current debt situation. So hopefully this video will help you break through some of that noise and give you some of the facts and what's actually happening in this situation. Now Fitch, the credit rating agency, stated that one of the main reasons for this downgrade was the increased polarization in our politics, and stated that events like January 6th and other tumultuous events throughout the past couple of years were a main consideration for the reason that they downgraded us. Now, they clearly believe that this increased friction will manifest its way into our policymakers and our monetary policy, as we can't pass a new debt ceiling budget without it coming up to the last minute. Now, many politicians, especially the Democrats, have pushed back against this, including the Treasury Secretary and the White House. Now, they've come out after this claim saying it's a baseless claim and the downgrade was just completely unwarranted. And they have dismissed this downgrade as nothing more than a political attack or an attention grab from the rating agency. But I think most investors can see through this typical political response, as there has been much doubt in the government's ability to pay back its long debt obligations and responsibly allocate tax dollars, as well as taking on new high levels of debt. Now, this graph right here displays the debt to GDP ratio of the United States federal government. Now, this has reached nearly 120%, and that indicates that the debt is growing faster than our economy's productivity. Now, it's important to note that this ratio is not the only factor to consider, as this debt could have been spent on ventures that benefited society and generated higher tax revenue in the long run, even if it hurt the short-term financial health of the United States. But let's take a closer look at the budget deficits to see if there's any deficit spending that has paid off. Now, looking at this graph, the last year the US was able to generate a surplus was in the early 2000s, and since then, it has been a roller coaster ride of larger and larger deficits. Now, it's pretty clear from this graph that the government's spending is detached from reality in some way, as most companies and organizations cannot spend vastly more than they make and still survive. Now, this is starting to show in the people that fear the government's fiscal position is worsening to the point of no return. Now, the question still remains, when will things break? And that question does not have a clear, straightforward answer, as large economies like Japan have over 230% debt to GDP, and we're only at 120. So could we get to 200, 300, 400%? At what point do things really break? And it's hard to determine because there is no clear-cut line that we cannot cross in terms of our deficits or debt spending levels. But from a fundamental financial perspective, anytime you cross deficits over 100%, debt to GDP, you play a dangerous game, and the risk does become increased that you do default over time. And even if you can't default because you can print the money, other countries may lower their demand for your dollar as they see that you're just printing away their valuable currency. Now, not only does this shake confidence abroad in your ability to pay back your debt, but it can also lead to an unfair deal for other countries. Because when you print currency and use US dollars to trade internationally, they essentially print whatever good or service they need abroad in the form of debt and give away this less valuable currency to other sovereign nations. And this perspective can cause massive tensions between us and other countries, as the country with the world reserve currency disproportionately benefits from the privilege, while the other countries can oftentimes suffer. Now, my personal opinion is that although we don't know when the system could break, or if it even would, in terms of spending or debt levels, we should do everything in our power to maintain economic dominance across the world and get our spending and debt levels down to a more manageable level by cutting back excessive spending in multiple different categories. Now, what is the way out of this situation? If the government wants to improve the position when it comes to debt and to spending, they are faced with a few different options. They could raise taxes, cut spending, grow productivity, or inflate away this debt. Now, the first one, raising taxes. This would be extremely unpopular and could incentivize the people who pay the most in taxes, which is the wealthier individuals within our country and the corporations, to leave. We've also seen that regardless of the government's taxation policies, whether they were lower or higher in certain periods of time, they were never able to capture more than 20% of GDP, which could be a useful benchmark for the government to never spend more than 20%, because they know regardless of how they tax, they will never be able to get above that threshold. In the second category, cutting spending. Now, this seems like an easier task given that the stories many hear on the news regarding insanely expensive military contracts that don't materialize into much. But I think it's a little more nuanced than that. Entitlement cuts would be very unpopular and would most likely prevent politicians from ever getting voted into office. So that is kind of off the table. So that leaves us with defense spending, interest expense, and education as the biggest three expenses left. The easiest place to cut seems to be defense spending, as education expense would incite strikes and protests, but even cutting defense spending could prove to be problematic, as most politicians are lobbied by these larger weapon manufacturers like Lockheed Martin, Raytheon, and many more. And unless politicians are willing to stand up against their biggest donors, I don't think we'll see much of a change. And I also wouldn't count on politicians to act in a more ethical, moral way. And they can't cut back on their interest expense because they have all this debt and they can't repay it because they're running a deficit. So that interest expense is pretty locked in until we fix the deficit. Now, the government's other option is to let inflation run hot for a while and devalue the current amount of debt that they have. Although this does further exacerbate wealth inequalities and disparities and cause many other problems within society and the lower and the middle class, not that the government particularly cares, this is an option. Now, the one saving grace that the US government has always had is the robust, fast-growing US economy that continually bails out the government time and time again. And if the economy is able to grow its way out of this debt problem and the government's incompetence when it comes to spending, that would solve the problem by increasing tax receipts when the government doesn't even have to do anything. And this is totally out of the government's hands. It relies on individuals throughout society to create value across the world and across the United States. But oftentimes, when the government does more to intervene, it can actually be counterintuitive to what is actually they want to accomplish. Now, although I do have the utmost confidence in the US economy and the individuals that innovate and work within it, I don't like the idea that we just have to grow our way out of poor fiscal policy and terrible spending habits at a federal level. Now, finally, what does it mean for you and me, and what does it mean for investors? Well, the most likely outcome is that the government relies on the economy to grow its way out of this problem, while inflation continues to tick away at its overall debt. Now, both of these outcomes, if they are favorable and inflation isn't too high and our economy keeps growing, can present a huge opportunity for investors and capital appreciation within the markets. And holding cash in environments where the Federal Reserve maintains its goal of destroying your buying power to incentivize spending has proven to be a poor choice over the long run. Even holding bonds in environments like this can often bring years with negative real returns. Now, investors should always consider macroeconomic events like this, but they should also consider the fact that the markets and the economy as a whole have a large number of variables that make predicting events in markets based off of these events is just incredibly difficult. And that's why I choose to spend most of my time finding solid companies and with large moats that have sustainable growth into the future, rather than trying to ride these big macroeconomic swings, because they're just so hard to predict and the timing is even harder. Now, that's all I had for you guys today. It'll be interesting to see how all of this turns out and plays out with the Federal Reserve possibly cutting next year or continuing to raise throughout this year and everything that shakes out within the markets. So with that, I'll see you in the next one.